Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the first move to the downside over here, where if we zoom in on the 50-minute, the probabilities are higher. This is a 3-wave structure to the downside, and then a wave A 5-wave move, 1, 2, 3, 4, 5, then a wave B corrective structure, and eventually a wave C to the downside over here in a contracting diagonal. Now in this particular scenario, we do have to look at the volume, because you can see that once wave 3 was in or starting to get in, the volume started to increase, and it kind of continued in 4 and 5 compared to wave 1 and wave 2. And in a contracting diagonal, it is more common to see volume decreasing while the pattern is evolving. So this is something that we at least have to keep in mind. Now if we then zoom out again and look at the range as a whole, because the probabilities are higher, this is a 3-wave structure, it means that probabilities in general are higher to still take this high. However, we have a double bottom over here, and if we take a look at this structure over here, you will see why the probabilities are higher for price to actually move to the downside first. So if we look at that scenario, the ranging scenario here, we're then looking for a W being a zigzag, then we have wave X, and then we're looking for wave Y to either be a triangle or a flat in a sideways double combo, meaning for a flat we have an A, B wicking above, and then eventually a C to the downside to then take the double bottom over here. Now Bybit already took this low, but that increases probabilities that other charts will follow before we get some sort of continuation or a bigger move to the downside. Like we're looking for this low to be taken also on my Coinbase chart over here. Now a reason that the probabilities locally are higher for a move towards the downside also has to do with the structure of wave X. So let's zoom in to this wave X over here. And then what you see is over here a W, X, and a Y, where wave X is a flat and Y is also a flat, with W being a zigzag structure. Now in this scenario, we then have a wave A, a B, and a C, where the most common target for wave C is in between the two 1.618s, which has been nicely respected. We also had a daily naked point of control over here, so that is nice as well. But the main reason why this scenario is interesting is because of this move to the downside. The most common target for a wave C is between the 1 and the 1.236. So if this by itself would have been a 3-wave structure, you want wave C to get inside this area between the 1 and the 1.236 and then bounce from here. But as you can see, it came short, right? It hit the 0.618, and that is important for the more bullish scenario, because here we then have a WXY, which is already finished with a zigzag in wave Y. So you have an ABC to the downside, but the wave C came short compared to the normal and most common target of a wave C. Also, as W is then counted a zigzag in an ABC, and then you have X over here, wave Y in a sideways double combo cannot be a zigzag as well. So this is something to take into account. The only good thing, however, is that the 0.618 has been nicely respected. The 0.618 taken from the high to the low of W to the high of wave X has been nicely respected for then a move to the upside. Now if we then look towards the upside, we still expect actually a bit of a move to the downside first, because this is then a wave 1, then we're looking for a wave 2, but the most common target for a wave 2 is between the 0.5 Fib and the 0.786 Fibonacci taken from the low to the high of 1. You can see that over here the 382 has been tagged once, which is a more rare target for a wave 2. So preferably you are going to see price moving to the downside a little bit, hit some of these areas before then continuation. But if I open my target boxes, you can see the only one I have is around the 786 as some nice support between 27.4k and 27.5k. So if price does drop to the downside, this is an area of interest, which also means that is the 786. If it's not holding and we move further to the downside and potentially hit the 886, well, once the 886 is hit, which is a very rare target for a wave 2, probabilities increase that if we get a bounce after the 886 touch towards the upside, that this move to the upside is either a wave C or a wave Y. Probabilities are then lower that this is a wave 3. So this is something we have to keep in mind as well. If we then zoom into what we see over here more locally, then what is interesting is that price over here bounced on the 886. So this, of course, right, we're looking for still moves towards the downside. Also here locally a double bottom. But what is interesting here, and for me most important, is the 886 touch. So the 886 has been taken from the low to the high, and what I just explained is also the case here. We got the bounce from the 886, price moving away from the 886. That's exactly what you want to see, because if price does this and comes back immediately, probabilities are higher to just continue. So this is exactly what you want to see, but because the 886 has been hit, probabilities increase for the next move to the upside to be either a wave Y, a three-wave structure, or a wave C, meaning probabilities are higher for the double bottom over here to be taken before anything else happens. So this is also important more locally, so that is something to look for. You can also see the retracement went to the 0.5, just missed out on hitting the golden pocket. But the 0.5 to the 886 area for either wave B is fine. And of course, if we are looking for potential 1, 2, and now a 3 to come, the 0.5 to the 786 is the area of interest, which now has been hit as well. Also, if we look at the CVD divergences over here, then what you can see is we did have some bearish CVD divergences before. So over here, lower high on price, right? And let me actually remove the yellow line for a second. Lower high on price, but then if you look at blue and you keep an eye on this high over here, you can see that we have a higher high on the CVD. That's a bearish CVD divergence over here with this high, but also just now over here with this candle, you can see this peak on blue. So again, look to the right side of the chart, you can see the horizontal cursor line, and it dips above the horizontal cursor line, which is again a bearish CVD divergence with this high, lower high on price, a higher high on the blue CVD over here, which is a bearish CVD divergence. So at the moment, that is what we're looking for over here, bearish CVD divergence. One can argue that on yellow you also have bearish CVD with this little order block, this candle over here, lower high from the candle. But if you look at the yellow line, especially this area here, then you can see from this little pivot we have a higher high on yellow, which is also a bearish CVD divergence. So it's definitely interesting to keep an eye on how this move goes towards the downside, because as it moves down, you can see a little bit of bullish CVD coming now. However, the first CVD divergence appearing on the chart has the highest probability of playing out, which is the bearish CVD divergence over here, where the target of the divergence is taking this low. Now, another thing before I go to the probabilities is for the Elliott waivers here. If you want to study more about Elliott waves, go to the free websites. They're in the description, but also you can find the links here. But also another thing is that I shared, thanks to Jay-Z, so make sure to clap or give a thumbs up or whatnot. I shared 2 PDFs here. Right? And these PDFs are full of information that is very, very useful. First, a PDF with a lot of statistics about Elliott waves. Like this is a crazy PDF with many statistics about Elliott waves as well. So make sure to check it out. And it's a bit of like a book, Elliott Trader Secrets, Elite Trader Secrets here, where you can see a lot and read a lot about Elliott waves. So always good to have more information. So make sure to check this out. And if we then go to the probabilities of the different scenarios, then the highest probability on the micro is basically when we zoom out over here is for price to continue the range, right? For price to keep ranging in then a three-wave structure, looking for that double bottom over here at the downside as a minimum. And then more locally, because the 886 here got touched, the probabilities are higher. The move to the upside is a wave C or Y, which increases probabilities. We are still going to see more downside to at least take the double bottom. And if we do, keep an eye on this level over here. So I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.